Alrighty, welcome everyone. Good to see you all. I hope everybody's had a good week. Today, I'm very excited for myself and for you all to learn about some tax strategies and entity structuring and all the fun things and the reasons why we get into real estate. Of course, we love real estate because it's fun and we get to make good money, but it doesn't mean anything if you're not protecting yourself and figuring out ways to maximize your tax benefits and all the wonderful things that real estate does for us and that the system is built around. So we've got three amazing experienced guests here today to talk to us about taxes and cool ways to utilize tax strategies and ways we can structure our entities. So I really want you guys to be asking questions today. We have some slides here, but I would much prefer to have this be a conversation. Ask a lot of questions. We've got the resources here for you. Again, we have some slides that I'll use as a backup if we need them, but I really want it to be more of Q&A. We're going to ask some questions. You guys ask some questions. And whatever's going on with your business or wherever you are in your investing world, ask about it. Now is the time to do that. This is one of those topics that I know enough to be dangerous, but I'm here to learn too. So I encourage you guys to be interactive and ask some questions. And let me get this slide. So, Gage, you want to talk a little bit about grid? Putting you on the spot today.
Community of like-minded investors playing a part in the whole industry, something for everyone. Amateurs to experts, none of us are, any different. We're all just showing up and running through what kind of deals we can do together and how we can navigate the industry. Again, not gurus, just people doing deals.
Yep. We're here to learn, like I said, just as much as you guys are. So don't feel shy if you have questions. There's no dumb questions. We're all trying to build something and learn as we go a lot of the time. So again, I encourage you gues to ask away.
And speaking of that, can I mention, when you do ask away,
yes, thank you.
Guess the mic for you. Because if you ask it without the mic, then in our recording we can't actually hear the question. So if you could, when you raise your hand, just wait, we'll bring that mic to you so you can speak right into it. It's not amplifying or anything, it's just recording it internally.
Perfect. Thank you for that reminder. I would have forgotten about that today. Grid in and of itself, obviously we have Grid Shenandoah Valley here, but we've got locations spreading across the country. I think there's like 8 or 10 new ones that are opening in the next month. So if you guys are interested in doing deals in other markets, other parts of the country, go to gridinvestor.com, see if there's a grid chapter in that area. It's a great way to connect with people. It's a great resource. All of this stuff is free, by the way. We do it because we want to build relationships. We want to do deals with you guys. And so whether that's here or in Tampa, Florida, or in Vegas, or wherever we've got grid chapters, the same resources you get here, you can get in any market. Not any market, but the markets where we have these chapters. And it's really, those of you that may have attended GridCon last week, you see the impact that it's having. You see some of the people that are a part of this community, and there's some really high-level operators all around the country. So I encourage you guys, check out gridinvestor.com, see what other markets there are. Obviously we love it here. That's why we're here. That's why we're invested in this community, but there's a whole lot of other good markets where you can invest if you guys are interested in that. We're going to do some quick intros of ourselves. Then we're going to introduce our guests and we'll go ahead and get started. So Gage, take it away.
I'm Gage, own and operate Envision Holding Group. So we're Class A contractor, We have a building materials supply and design center in Winchester, so we supply all of our material. We have our own land development firm. We have acquisitions. It basically, soup to nuts, front to back on everything investment for fix and flip, short-term rental, new construction. We're here to help. Anything that you guys might need in the investor realm, whether you need us to flip a house for you or build you a short-term rental cabin, we got the boots on the ground for it.
Awesome. And I'm Mike Cappello, real estate investor with many hats, but mostly I own and operate Sell Simply, which is a sales and acquisitions business in Northern Virginia. I do some deals out here, obviously, but anywhere really from Richmond to Harrisonburg, up into the Panhandle of West Virginia, and along DC, and a little bit in Maryland. We wholesale some deals, we fix and flip some deals, we buy and hold some deals, so I've got a lot of experience in lots of different facets of the industry, including your creative finance stuff. Yeah, that's kind of it. So I'm going to skip. We've got a fuller room tonight. Does anybody have, before I skip through, does anybody new in the room that wants to maybe introduce themselves, or does anybody have an opportunity or something specific that they're looking for before we introduce our guests? Go ahead, Judy. No, please.
Hi, Judy Haynes.
Hold on, real quick. Mic it up.
Hi, I'm Judy Haynes, real estate agent of 20 plus years and been part of this group for 3-4 years now.
Yep.
But I want to announce that my first flip is done. Yay! It's been a long time coming, and thanks to Gage for helping out with that and really pulling the weight on it. So, but we're just got confirmation. It's finally done. And I am now looking for my next opportunity. I got money burning a hole in my pocket. So if you got something distressed that needs work that, doesn't cost too much money, I'm here.
Awesome. Proof of concept right there. Judy's one of our original members of Grid Shenandoah Valley, longtime agent, but wanted to learn the investment game, came out here, learned a lot in the first couple years, and then I guess was it the beginning of the year you bought it, or end of last year, bought her first deal, fixed it, flipped it, with Gage. So we're doing deals. Judy's one example, but there's lots of other examples. So if you guys are interested in doing deals here in the Shenandoah Valley, obviously, you're in the right place. Anybody else? Wins, intros. Matt, I'm going to pick on you, Matt. Why don't you introduce yourself?
Hi, my name is Matt Rupert. I'm with Main Street Home Loans. This is my first Grid investor meeting, and I am a new investor and very excited to learn, so thank you for having me here.
Amazing. Thank you, Matt. There we go.
Hi, I'm Todd. This is my wife, Melissa. We're from Percival. This is our first time here, and we're just looking forward to learning. We've, bought personal residences over the years, some creative things in those things for our home residents. We're thinking maybe we can do this on an investor level. So we're just looking forward to learning.
Oh, yeah. How'd you guys hear about us?
Somehow I got on your email list, and I just kept getting emails, and I was like, I guess I'll check them out.
It works. All right.
He's for real.
Well, I actually live in Leesburg, and I'm in Percival quite a bit, so you guys
Okay.
ever want to get together and grab a coffee or something,
Excellent.
I'm happy
Thank
to
you
do
very
that.
much.
Anybody else? Mikey? Go ahead, Mike.
And I contributed to these grid meetings. I purchased a 10-unit property, about maybe the end of last year, and I'm looking to get 5 more units, 2 separate 5 more units, maybe in a month or 2. So it's all because of meeting people like this, getting to know people. Nobody at this particular meeting, not yet, but it's coming, it's coming.
For sure.
But yeah.
Keep showing up. Thanks, Mike. All right.
Can I jump in really quick? For you guys who are here for your first meetings, that's awesome. I remember the first time that I came to one of these meetings, I was so overwhelmed, and I was like, I don't know what's going on, and I didn't want to come back, but for whatever reason, and it wasn't Shenandoah Valley, it was a different one. That one's shut down too, it doesn't even exist anymore. But I didn't come back for a couple months, and then somebody encouraged me to come back, and so I did, and I've been coming consistently every single month since then. So glad that you guys are here tonight, and hopefully you meet a lot of great people. But no matter how tonight goes, I want you guys to come back next month. And you guys in particular, being in Purcellville, there's another great grid meetup in Reston, and so you guys are kind of right in between those. I go to both of those every single month, and so it's really important to just do it consistently and keep getting in the rooms and keep building those connections. So thrilled to see you guys here tonight, and hopefully I see you guys here next month and the month after that. And for anybody else who didn't want to introduce themselves, I think that's true for everybody. The more you guys come, the more you guys build these relationships, the more impactful this experience will be, and it will be what you make of it. So you could come and you could sit in the back and you could not ask any questions and not meet anybody, and that's cool, but you guys are investing your time tonight to show up, so maximize on that and make the most of it and build the connections and keep showing up, because that will pay dividends.
You're hired.
Go ahead.
Snapper's another great example, though. I mean, he basically explained it, but I remember meeting Snapper many years ago, and he's just shown up, and I've seen him, grow within our world. And every meetup I go, everybody knows Snapper now. Like, it's just, so it's really cool to see. Thank you, Snapper. All right. Important legal stuff. Don't sue us. We're not giving legal advice. We're not giving any real tax advice. Maybe we are, I don't know. But do your own due diligence. We're just telling you what we know. We're filming, obviously, taking pictures if you don't want your picture taken. I don't know what you can do. Put a bag over your head. All right, without further ado, I'm gonna let our guests of the night introduce themselves. They all have very interesting stories, very unique lanes that they work in. Isabel, go ahead.
I'm Isabel Uribe. I am an investor and a tax strategist. I'm not a CPA, so all my advice has come from, what has worked for me and for the people that I know. But yes, right now I do work a lot with people who are in the real estate business, or they don't know they should be in the real estate business, because this strategy, some people, it's basically benefiting everybody, and some people that have never invested in real estate have become like big investors because of the tax strategies that we work with. So yeah, it's something that is definitely, if you're in this area, it's definitely something that you kind of like, I advise that you learn well, because it's definitely game changer.
Awesome. Michael?
Yeah, my name's Mike DiNardo. I'm a real estate investor and operator and advisor. And like Isabel, I was doing things kind of all wrong until I understood how real estate can impact not only your net worth, your monthly cash flow, but what's the biggest expense everyone has, right? Like taxes, right? So how can you retain more of what you make? And real estate's a really cool vehicle to do that. If anyone knows any other vehicles, I'm open to them. I just haven't found any yet. So, but let's see, I've been investing in real estate for about 17 years, and I actually just exited my corporate sales job to do this full time. So, yeah. Really excited because, I've spent a lot of time, probably like a lot of people, working 9 to 5 and then kind of doing this on the side. And it got to the point where, I was making more money in real estate than at my job. So I said, well, let's like flip the switch. So we founded an advisory practice, my wife and I, Lifestyle Real Estate Advisors. And what we're doing is just helping other people do what we're doing, right? Is investing in real estate, optimizing the real estate, different strategies that they may not be aware of, to increase their cash flow and their net worth and maximize real estate. So the services that we provide outside of just being, investors ourselves, is to help people that are not exposed to real estate get exposed into real estate, right? It's kind of daunting if you don't own investment real estate. Like, what do I do for contractors and cleaners and maintenance and calls, right? Like, we've done all that. So we're just sharing what we've done over the last, 17 years investing in real estate. The second component from an advisory perspective is sometimes people have vacation homes. That's cool, but that's a liability. It's not really an asset, right? So if you want to turn your vacation home from a liability into an asset, we can help in the form of a short-term rental. And we have a few in this market that we're doing that. But the concepts are the same wherever you go. You just need to, look at key things in the market. And then the third piece is bad operators, right? So there's a lot of people that own investment real estate, but they don't do it well in terms of managing the asset, right? So we just take what we're doing to help other people replicate that. And we were lucky enough, one of our cabins, thank you, Gage, he did the renovation, is top 1% on Airbnb in this market. So, we know what we're doing, and we're just trying to help other people do that. And then we also do co-hosting. So, again, just plug it into our systems. We can manage the guest communication. And then we also do property insurance. I'm a licensed property and casualty insurance advisor. So anything related to real estate, we're here to help and just trying to share, what we've done. But I'm excited that I'm doing this full time. So Mike and Aaron and Gage, thanks for having me, because these are the rooms that I like to be in, not those corporate stuffy rooms. And I'm probably a little overdressed tonight, so I apologize, but this is all I had.
Where's
So
your bathing suit?
yeah.
Summer.
That's me.
All right, Snap. Let's hear it, man.
Damn, well, I don't know how I made it up here with the two of them, because holy cow. My name is Snapper Tams. I'm an attorney. They're going to talk a lot about how to maximize your investments, which is awesome. So they're going to help you raise the roof. My job is to limit your liability and help raise your floor, because you're potentially investing a lot of money and taking a lot of risk in doing these deals. And so where they're focused on maximization, I'm focused on liability protection and putting you guys in the best position to succeed. So I'm one of the founding partners of a law firm in Leesburg called Cerulean Law Group. We have a broad practice area, but as it relates to this room and you guys, we do a lot of business and real estate matters. And estate planning too. I guess we do estate planning would be relevant for you guys as well. And then also personal injury, criminal defense, and a few other matters. Excited to talk to you guys, but frankly, I feel like I should shut up because the two of them, holy cow, have a lot to say. So thank you guys for having me.
Great. Well, you guys heard it. We got a lot of wisdom up here. So again, I encourage you guys to ask some questions. Okay. So again, why does this all matter, right? We are investors. We're focused on buying deals, raising money, building a portfolio, whatever. But a lot of, to Mike's point earlier, what a lot of people do is they see the glitz and glamour of it all, but they're not really protecting themselves properly. They're not setting up the right systems. They're not leveraging the assets that they own with their taxes and, maximizing or limiting their liability on the tax side. So it may look good on Airbnb or whatever, but when you look at it on paper, it doesn't look great. So that's why we've got these guys here to talk to us a little bit about how do we limit our exposure? How do we structure these things? How do we deal with the taxes or take advantage of the tax benefits that we have through real estate? So again, I don't want to sit here and read these slides. What I would encourage you guys to do is does anybody have any general questions before we get started and leaning into the slides? Does anybody have any general questions that come to their mind when you hear the experience that these guys have, or questions or reasons why you showed up to this meeting today? I'm happy to sit here and run through slides and ask some questions myself, but I'd love to hear what the group has to say. Go ahead, Mike.
I hope this will be a good answer, a good question. I've heard about the being able to do accelerated tax deduction. I don't know what advantages there are to that. Can you help enlighten me a little bit on this? Just like I said, I just bought myself a 10-unit place. I'm getting ready to buy 2 more. Should I depreciate all of them this year, or should I? I'm a long-term investor. I've been doing it before you guys were born. But you know, just what's the advantages of doing it?
I would just say what your income looks like this year. That would probably answer the question, and what you want your effective tax rate to be, right? So if you bonus depreciate it, it's not as, and you're a real estate investor.
That's all I do.
So you have real estate professional status.
No, I'm just me.
If that's all you do, it's probably the way you're set up. But basically what you can do is just take the extra depreciation in year 1 with a cost segregation study to wipe out income, right? So quick math, right? Let's say you bought $1 million property, and on average, you could say that the bonus depreciation in year 1 is about 25%, right? So for kind of quick numbers.
Okay.
So if you do bonus depreciation with a cost segregation study, you can take $250,000 against your income. So if you make $250,000 this year, guess what your effective tax rate is? 0%. Guess how much taxes you pay? 0%. Now that's this 1 year.
And
So that's like a longer, conversation based on what you're doing, but that would be an advantage if you did that.
also, the law changed last year, so it is important to think that this is one of the years that we're going to have that at 100%. So, like he explained it, you're going to get that 250,000 at 100. That's going to be 100% deducted from your income. So, well, lost from your income. So, we don't know how long this is gonna last. It's supposed to last, but we really don't know. So this year is it's an advantage that we as investors have because of that.
Good year to buy real estate this year is.
Yeah,
What was that? I'm sorry.
This is a good year to buy real estate.
and you have to put it to work.
Yeah.
I guess my biggest question is, I'm 70, and so I don't know if I want to keep another property for 20, 30 years yet. I ain't going to be around that much longer. So if I want to sell in 4 or 5 years, am I going to get killed?
Yeah, it's the recapture on it, right? So
that's what
yeah, so you could, 1031 that obviously. You could put it into what's called a Delaware statutory trust,
Right.
which you're familiar
That's
with
what I'll
that.
probably do.
So-
Those are different ways, but yeah, if you do sell it and you take those gains, the recapture that you basically take this year comes back in some form.
It is also something that for any property that is not even the ones that are depreciated, it's very important thing to think about doing something like a 1031 exchange, because then you're going to be deferring those taxes, like you're just going to be pushing them. So it is something that it's important to consider that anyway.
And if I'm sorry.
You're fine.
And so then if I do the 1031 tax exchange into a DST, then there won't be no taxes being now transferred into the DST. But is really that the only type of a 1031 I can do? Something into, it's going to be pointless for me to buy $1 million property, then sell it or trade it into another place. That's just pointless. You understand what I'm saying? So is there anything else other than a DST that I could invest in?
In my experience, I think it's just another property doing 1031 exchange or
Okay.
DST. Otherwise, you're gonna sell it, and good, but you're gonna pay a bunch there.
Yeah. Yeah.
Which is, okay as well.
But now, and the other thing is, when I pass away, then the heir, they won't have to pay the accelerated. See, that's what I'm thinking. They didn't have to pay the accelerated. If I claim accelerated this year, if I pass away in 2 years, which quite may be logical, but
No.
they wouldn't have, my heirs wouldn't have to pay that recovery, even if they wanted to sell.
If they keep investing in getting another 1031 exchange, they can keep deferring taxes forever.
Okay. But if they decide to sell, then they sell at whatever price it's worth right then, in 2 years.
Well, when you inherit a property, then it gets I mean, so the amount of taxes that you have to pay is not for the property, I mean, how much it costs, is how much it costs now. It's not how much it costs to the buyer when it bought it, it's how much it costs now.
Right.
So it
Okay.
is, I think it's a benefit for them as
Yeah.
well.
Okay. I'll leave you alone.
And I think just maybe to add to like, I was just gonna say to add to Mike's question, and I know we have another question. I didn't really look at this until recently, right? Like the way that I usually did my tax planning was at the end of the year, I'm like, cool, what other deductions can I do at the end of the year, right? And then like, okay, how much do I owe or how much do I get back when I file my taxes? And I think that's a really bad way to do it. Another way potentially would be to forecast what you expect to make income this year. Okay, 200,000, 100,000, 300,000. Okay, this is my projected income. So now in June, what moves am I going to make between now and the end of the year to reduce my effective tax rate? Your 401k, your HSA, your charity, your 529, real estate with bonus appreciation. Gage has a company, right? And correct me if I'm wrong, equipment, right? You can also bonus depreciate that. So there's a lot of deductions if you own businesses, right? But the time to do it isn't in December or next April. It's too late. The time to do it is now, and it takes a lot of work. Like, it's not fun, and like CPAs aren't going to do it for you typically because that's not what they're paid for. They're paid to, complete your return. But a strategist or, just do some research on ChatGPT or whatever, figure out like what's available for you and talk to people that have done it before.
And the important thing, just jumping on what you're saying, is that you have to do it before December 31st. It's not before tax day, it's not before April, it's before December 31st. So it to count for this year.
But if you try to buy a property on December 1st, well, you're going to be forced to make a bad decision, right? So like if you plan on buying something before this year, start looking now. Or whatever the move is, right?
Also,
like
it's
you
not
got to
when
plan for it.
It's not when you buy it, it's when you put it to work.
service. Yeah.
So it's whenever you have your first tenant or your first, whenever it's actually producing money. So if you buy it on December 31st, it's not going to work.
Okay, that's all I need, thank you.
Who had the question?
Oh, I was just curious. I feel like I've read something about what do the tax implications look like if he were to own or finance the property to somebody that wanted to purchase it? What does that look like in terms of his tax impact?
I'm not familiar with any additional benefits. There may be some.
And remember that you're buying, it's about how much money you're making. It's not how you got the property. It's about how much income you're producing for the property. So yes, many of your properties may have a mortgage or may not, but the important thing for the IRS is not the mortgage, it's how much money you're putting in your pocket. You know what I'm saying? So the taxes have to do with how much income you're taking home. So yeah, it's just like, and so if it's financed by the seller, it's about how much rental is producing.
Right.
So I'm not a CPA, financial
me neither.
advisor, right? I'm not aware of any additional benefits, right? Because the financing is different than like the depreciation aspect, right? So it doesn't matter if you buy it in cash or you finance it, you buy it, or owner finance it.
I'm so sorry to interrupt.
For the seller.
Speak a little bit
Yeah.
louder.
Yeah.
So I know he just
but
asked
for
the question
the
right here.
seller.
The people out there,
does.
yes. So I think it's just, creative financing is amazing for anything.
Right,
So
right.
if you're able to do that, it doesn't change anything
Okay.
from the tax advantages. It's just the way you got the property. So if you're able to do that, yeah,
Right.
go
Well,
ahead and
I
do
think,
it.
I think I understand what you're asking, which is, if he were to sell his $1 million property that he bought for $800,000 in 5 years, and he had a effective $2,000 gain on that property, if he were to, instead of take that gain all at one time, $200,000 in one lump sum, and he were to seller finance or do some kind of creative deal where
yeah.
he seller finance his equity to
Right.
somebody and then spread that liability over time,
Right.
then there's a benefit there because he's
Yeah.
not paying taxes on $200,000, he's only paying taxes on whatever he's making each additional year. And potentially when you seller finance, you charge interest, so you can make more in the long term by doing it that way versus selling it all at one time and just taking the $200,000
Yeah.
and getting taxed
For
on
the
$200,000.
seller, it's amazing.
Right,
If
right,
you don't
right.
need the money right then,
Yeah.
you're not going to pay capital gains. So
Right,
for the
right,
seller, for
right.
the seller, it's amazing. Yeah.
Yeah.
So it's one of the ways you can structure your deal with the seller is, hey, so the way this benefits you is that you're not going to pay that much in taxes. You're not going to pay those capital gains. So it's a way to kind of like convince them to do seller financing for you because it's benefiting for them as well.
Cool. Thanks.
Does that make sense?
I think so.
So one question on the example you just gave about the seller financing. If he did do the accelerated depreciation rate and got that, would the recapture would still happen in the year that he sold it, correct? But then the rest of the capital gains, so you would still have to figure out a way to offset that recapture.
Yeah.
Is that correct? Okay. Just-
I guess I can ask a newbie question. When I think about getting into it, my question is like the structuring of it and how do you protect yourself from the liability? We have a business, so we are familiar with LLC and, running a business and stuff like that. But if you're buying properties, is there like an LLC for each property? Is that underneath other LLCs? How many LLCs get created in this whole thing? And if you're getting a loan, can you do that with an LLC or along those kind of lines? Can you help?
Yes, great questions.
I put every property into its individual LLC, and there's structure above that you can get into as you progress and have a whole bunch of LLCs that are ran by an S corp. But yeah, each property I put into LLC, it's its own person.
And why
Yeah,
do we
and
do
then-
that,
and then-
Snapper?
Yes, and then you can,
And you
surround
can't get
yourself
lending.
by amazing people like
Actually
Snapper.
really great lending that doesn't hit your personal credit.
Really?
Things like
Okay.
that.
So
Yeah.
even starting out, like just
Yep.
forming an LLC that hasn't have any history, you can still get lending for that?
Yep, 100%.
And then when you keep growing and it's difficult to manage that many LLCs,
You hire Mike.
yeah, well, you talk to Snapper for sure, but the other, and you hire Mike, of course. Oh, yes. But my point was that when it's difficult, there's certain thresholds that he may be able to like talk about better because but there's certain structure to keep it all protected, and it's definitely something that you want to look for because yeah, it's just. But yeah, he will be able to answer that better than I will.
This was great. I was sitting up here, best seat in the house, having answered no questions. you threw me off, man. You ruined my plan. So as far as do you have one LLC per property, it depends on what you want to do and what you want from it. Forming an LLC is not difficult. It's an easy process. The safest way to do it is definitely one LLC per property, but there's nothing that says that it has to be one LLC per property. You could put 3, 5, a portfolio of 20, however many you want in one LLC. But think about it like this. Each LLC is a fireproof safe. So if there's a fire that comes by and gets into that safe, whatever is in that safe is at risk. So if there's a property at 123 Main Street and you own 5 other properties in the same LLC, then not just 123 Main Street, but all the other properties could be at risk if there's a judgment against whatever happened at 123 Main Street. If, however, you have just 123 Main Street in that one LLC, then that's it. And so the fire is limited to just what happened in that safe. So as a general rule of thumb, one LLC per one property I think is a great rule, but there's nothing that says that you have to do it. That's just the safest way to sort of structure it and handle it.
And I'll say too, Todd, on like the financing aspect, depending on the lender, like Gage said, there's definitely lenders, like some lenders want it in LLC, like specifically if it's like a debt service coverage or it's based on the asset performance. But sometimes traditional lenders, you know, will want it in a personal name. And you can, you know, transfer that, like again, not an attorney, not, you know, a CPA, just showing, you know, what we've done. You can transfer that, right, into an LLC after closing. There's typically a due on sale clause, right, for your mortgages. If you're paying the mortgage, right, like I don't know why they would do that, but you know, there's like a risk run if you're talking to an attorney, like, hey, should I transfer this from my personal name to an LLC after closing? We just closed in an LLC, right? So you can do it, you know, with financing. So a lot of different opinions and different things there, but there's certainly a way to do it.
And also sometimes you can leverage the credit of your LLC as well, you know, like your credit history of your LLC as well. So it's something to consider as well.
All right, so my question was, do you guys recommend doing like an umbrella or a holding company and then have the LLCs under that? I've heard mixed signals from people who do just literally an LLC and then they run all their numbers and they do a tax return for all of that, where I feel like I was kind of pushed to do one holding company, kind of pay myself from that, and have all the other ones basically net out zero and pay up to the LLC that I get paid from. So what's the strategy you guys use now?
Probably the most common structure, what you just described, like each property in an LLC, then like a holding or an operating company. So you file like one tax return and it's a little bit cleaner. You also want to look at like, from a liability perspective, like maybe an umbrella policy, like over top, like the property, like that's maybe above what the coverage levels are. But I think that's how a lot of investors do it. And then there's layers beyond that in terms of like trust or LLCs in other states like Wyoming that have anonymity. So there's like a deep rabbit hole, I think, that you can go down there too.
Pierce the veil,
Yeah.
like Wyoming and some of these other ones.
Also with that, yes. I mean, I think it works great, honestly, and a lot of people are doing it. But I just wanted to add that from the tax perspective, if you have that kind of structure and that company that is kind of like your holdings is an S corp, you can pay yourself a salary, and then your tax game change, everything changes. A reasonable salary.
That's what everyone does quotes. You can't make $1 million and pay yourself $50,000.
No.
Right.
No, and it also has to have to do with your way of living.
Right.
So that's what the IRS is going to look after. You know, like if you're like driving, you know, amazing cars and you're paying yourself $50,000 a year, then it's not going to make sense. So that's.
Speaking specifically to the from the liability perspective of that, not any of the tax stuff. The holding company with the LLCs underneath it is very popular. Wyoming as the location for the holding company is very popular for the anonymity purposes. But you were addressing piercing the corporate veil. The biggest thing there is each LLC still needs to funnel straight up to the holding company and not be dealing with each other in a way that the funds are going to be commingled, because that's one of the quickest ways to risk piercing the corporate veil is commingling of funds between them or not treating them as individual entities.
One of the things that's a pain in the ass is literally paying myself up a ladder and so I can pay myself.
Yeah.
And it's a pain in the ass because I've got all these properties and it's checks all getting deposited, but then one check to myself at the end. But yeah, I get it. And, you know,
Yeah.
That's again about keeping things separate.
Yeah.
Exactly.
Yeah, and that is I think a lot of people commingle even with personal. With personal income as well. Like it's like just as long as you have it organized, you'll be good.
And just quickly, and I'm sorry, Judy, really quick, we're talking about commingling. LLCs can offer you a ton of protection. They are great, very flexible business entities, easy to start, easy to run, easy to manage, but just starting the LLC is not itself enough. You want to make sure that you're treating that LLC as a separate and distinct entity, separate from yourself. You're not commingling funds like Isabel was talking about between yourself and like that LLC needs to be treated as its own special separate business entity. And so form the LLC, treat it like its own separate entity, and those two things will go a long ways in protecting your personal whatever, your personal house, car, all of your personal assets. Because otherwise, forming the LLC and then commingling all your funds, you've now eroded all of the LLC protections that you went through the hassle to get, and now everything's potentially at risk. So just like, why would you do that? Piercing the corporate veil is considered to be an extraordinary remedy, but I've definitely seen it happen before. So you certainly want to avoid doing that, and commingling your funds is one of the silliest ways to just get rid of all what you'd set up for yourself.
Yeah, I think my question was exactly to that point, was, so when you're setting up an LLC, Gage says one per property, and having just flipped a property, created an LLC for it, then of course you have to set up a bank account for it, and then trying to just pay Gage was like jumping through hoops because they didn't want me to transfer more than, $12,000 a day or whatever. And it's like, people, I need to send Gage money. So the question is, so when you do you need a bank account for each LLC? Yeah. Or if you have this holding company, does that just have it? I mean, I guess, where do your levels come in? And then you're paying, your $15 a month for each bank account that you have. So, I'm trying to save my pennies too, but where does that all lie?
Oh, I thought you were going to jump in. So from a liability standpoint, well, they're the practical ones, so I'll let them talk to the practical implications and the $15 service fee and getting Gage paid, because Gage needs to get paid.
I appreciate that, thank you.
But yes, you're going to want to treat each one separately, and it sucks, and it's not an efficient process to get all of that going, but yeah, you're going to want to keep everything separate and distinct, and not run the risk of having different pieces flowing together. And should these two LLCs really be considered by the court to just be one because they were treated together as separately or as one thing and not separately? So yeah, sorry, Judy.
No, that's okay. Yeah,
I think a lot of people, like, obviously that's the best and the most, like, from an attorney, right? Like, you're the safest, like, that way. Everything's completely separate, completely different businesses, like, they're not commingled. The fact is, they're owned by the same people, right? And there's like an entity, right? So I think what a lot of people do is that operating company that has like the income, the expenses, and then things are segmented and tracked, right, through accounting and, et cetera. So like most people that I work with and know, like if they have 10 properties, they don't file 10 separate tax returns for each property, right? But they do have income and they have expenses allocated and separated, right? So just depends on how far you want to go. I mean, you could set up a LLC in Wyoming and then have it, be in a trust and then have an offshore bank account. Like you could go down the rabbit hole of protection there. So you just, you want to do as good of a job as you can.
So just starting out, like I said, I have 2 rental properties. I have that in one LLC. And I know, like you said, both of those are at risk for each other, but they're smaller properties, and so I felt comfortable with that. And my thought going forward on the flipping, since I'm really, at this point, not doing more than one flip at a time, is to create one LLC, then run each flip into that LLC rather than setting up a new LLC and a new bank account each time. Does that kind of strategy make sense? Or
yes,
what
but this is a property that you're flipping. It's different when it's rental income.
Okay.
When it's rental income, it's what I guess is what Snapper is talking about, like keeping it different, like not commingling, because then if something happens in that property, if someone falls, then you're putting at risk everything else as well. In this case, it's not the same case because you're flipping one at a time. So it's not like something's going to happen somewhere else.
Closing out the account at the end of the year on your taxes, so it's an LLC that needs to file. So
my CPA has been filing my LLCs
I create them
through
and
my
throw them
personal.
away as fast as I make them anymore. I don't know how many LLCs we've
That's
done.
true, and it's
100
cheap and
probably.
it's easy, so it's not like,
We flipped repeated properties within the same LLC. Yeah, just pass it to your CPA.
I have other
figure it
three
out.
questions.
Yeah.
I'm gonna go in the sequence that the hands were raised.
So you said by keeping them in the LLC, you're creating that protection. But let's say you have the property, but it needs funding. So if I'm funding it through my personal, I've lost that protection?
No, so you're talking about, you're sending money from you personally into your LLC to pay
Yeah.
for the,
Whatever.
yeah, to pay
Renovation,
for.
whatever, yeah.
Right, so the new repair or whatever, and no, that's gonna be different.
Okay.
Commingling is gonna be using the LLC to pay your home mortgage.
Oh, for the car
Take
payment or
yourself
something
out
like
for
that.
lunch,
Okay.
that's not a business lunch, make your car payment, like.
Gotcha.
Yeah.
Okay, just making sure.
It's a much bigger issue flowing that way than it is you into the, yeah.
But don't you still need a bank account for that LLC?
And I assume that he's talking about, he's taking money from his personal bank account, sending it to his LLC's bank account to pay for whatever.
Just fund, yeah, just
Yeah.
funding, just
Yes.
funding it and having money
Yeah.
in it to go to Home Depot or whatever you want.
Yeah, because
I
you're
d-
the owner anyway, so
Yeah.
how is that, I mean, at least at the beginning, how is it gonna survive if you're not putting money into it, you know? Like, it's okay.
This is a capital contribution.
Yeah, you're just funding your business.
Yeah. So I was gonna say, like, for me, like, just for people that don't know, like, I'm a flipper, like, and I don't buy and hold, I don't portfolio. So there's answers to how you do these things. But for me, I have an LLC that, like, similar to Mike, where I just have one that is my flipping business. I have another real estate venture, website, stuff like that. That's another LLC. They all pay up to one. The flipping business is pretty great because every project is a profit and loss statement. Literally, you just, here's what we made, $72,000. That gets taken out of the account, rolled up, and then up to my umbrella or my holding company, and then I pay myself from that. It's a pain in the ass to get an account with everybody, but you need to do it because literally it's just, at the end of the year, you're writing a P&L that says that company made $0, it paid up, and then you're just really getting one tax return on your umbrella. And I think for me, it's easy. You can get credit cards for each of them too, so there's opportunities there, but it all goes to the same account. And it's just easy to structure, just for future reference.
Snapper might be able to help us, but my understanding in Judy's example is she was using an LLC and rolling them through, right? Property A, B, and C, sell A and B, still got C, go to D. My attorneys would say that it's much better to close that out. Once you've paid your taxes, 365th day, close it. Otherwise, you have a tail of liability that flows behind. Say there's an electrical circuit that was installed without the right certified guy to do it, and there's a fire and you're culpable. It carries forward with you. You have to close that out and try to protect yourself.
Yeah, so you're talking about flips and LLCs, and just so everybody in the back can hear, you're talking about using one LLC for repeated flip projects, and you flip A, B, C, D, and now you're on E, and you only done one at a time, and so now you've sold A, B, C, and D. You're currently flipping E, you're all the way down the line, and suddenly there's an issue that came with property B a year and a half ago, and now you can be sued despite the fact that you're on E. Had you closed it out on each and every one of them, then there's nothing to go after. So that's sort of the advantage of doing it that way. Now, that is a pain to start it up and then shut it down, and I think there's probably less just likelihood of that situation versus if you currently have 5 separate properties, something going wrong at one of them. So from a practical standpoint, there's a consideration to be made as to whether you want to do that, but from a legal standpoint, you're absolutely right, is if the LLC that did that project still exists, then yeah, we could go sue them down the road 2 years.
Yeah. I just ball them up, throw 'em
Yeah,
away.
and that way you're
Every
shutting the
single
door.
time.
Yeah.
My question is, the umbrella company, is all the accounting mostly done there? Because I'm the bookkeeper for our business, right? So like I'm thinking about QuickBooks, and I'm thinking about how many bank accounts and all these LLCs. How does that work?
So I'm an attorney, I don't know math at all.
Okay. I mean,
What I have seen successfully is to treat it as a property management company. You know, so all the LLCs So, like, especially if you have many, you know, if you have one, then this doesn't make sense. But if you have many, then they don't necessarily have to have a bank account, and it's everything is going, I mean, to the property management company.
Okay.
That's what I have seen successfully.
Property management company is where all the accounting
And
or
that
the
is-
bookkeeping could
It's the
happen.
opposite. It's your actual day-to-day operations is your LLC that's on the lower level. So like, I'm HSS Home Buyers, and I have Valley Ventures as my umbrella. HSS has all the things, the Home Depot things, the credit cards, all that stuff. That's
Right.
where the major accounting's done. Then profit is shown up here. And
Yep.
then to Valor, which pays me. So there's literally almost no accounting on the top level.
Oh, okay.
Literally just profit and payouts. The hairy accounting is really the day-to-day operations LLC.
Okay. And is it something like QuickBooks what people
100%.
use? And all with it all in the same QuickBooks, or is that
Yeah, and with QuickBooks, you can obviously.
with
break
all
it
the
down
bank accounts?
With different bank accounts, right?
Right.
You'll automatically download it all. I've got a guy who does all that, but it's, if you're doing it, it's that simple. You just connect it to Truist or whoever, it automatically downloads, and then sometimes it knows how to qualify it too, so.
Okay.
But yeah, it's very easy, to answer your question, it's the lower level, with the day-to-day operations.
Right, all the
It's
transactions,
Yeah.
right?
Sorry, I should be running this thing, I think.
Yeah.
Any other questions?
Oh, go ahead, Mike.
We like that.
So how screwed am I since I've commingled?
We're back to common mistakes that we make. How screwed is he for commingling his
I
funds?
have an awful lot of properties, and I pretty much only have like 4 checking accounts. I couldn't have a checking account for all 100 different properties.
Yeah, so how screwed are you actually?
Yeah.
Right now, not, until something happens and goes wrong and you get sued, and then potentially significantly. But like, commingling's, at least from a liability standpoint, commingling is not going to become an issue unless and until somebody tries to sue one entity. The commingling will unlock the other entities down the road, potentially you personally, depending on how you were commingling. It's really just going to unlock the door. So you have these fireproof safes, and you're now creating like a tunnel burrowing through each of the fireproof safes, at least that were involved.
Is there any way I can stop today and then start tomorrow with all new 100 properties, or what?
Yeah, shut down your LLCs and start new ones without commingling.
Shut down the old, completely shut them down,
Start the new ones.
and then whatever mortgages I have, I can transfer that title name over to that.
And stop commingling.
And then, yeah,
New now like reintegrated fireproof safes.
Yeah.
Or I'd talk about ships too, water, airtight compartments underneath, same concept.
okay. And I really do need to get 100 different checking accounts?
I would say yes. I'm the
Hire
attorney.
someone.
How else would you collect and disperse funds? Yeah, they're their own person.
They might have a different answer. I'm going to cover my ears.
Yeah.
Okay.
Any other questions at the moment?
We'll help you, and then you can sell us creatively your property. I'll set up all the new LLCs.
And that's how deals happen in this room, just like that.
That's absolutely right, that's how deals happen.
All right, so we talked a lot about some tax strategies, some entity stuff. I want to give Mike an opportunity here to talk a little bit about this STR tax loophole that we're working with. Mike, is there any good place to start there?
Yeah, maybe like a pulse from the room. Okay, so who does not do real estate full time? Okay. So everyone else that kept their hand down, just give me maybe a couple nods. You guys are a real estate professional per the IRS, right? Okay, so everyone with their hands down, this doesn't apply to you, because this is only for people that are not real estate professionals. So everyone that raised their hand, this is something that's important. So basically, you can't take the depreciation losses that are viewed as passive in real estate, right? So a way to get around that is through short-term rentals and what's called the short-term rental tax loophole. So really basically, right, anyone that has a full-time job outside of real estate, meaning that they don't qualify to take the depreciation, those great tax benefits, right? You can buy a property, put it into service that year, work more than 100 hours between you and your spouse, if you file jointly, on that property. And then that is considered now active income because you're materially participating in it. It needs to be over 100 hours and more than anyone else, including Gage's team and your cleaners, right? And that has to be documented. So you keep a log, you say, hey, I did this on this property. I went to the property for a week on vacation and we did this and, et cetera, right? So you log that. You can then take the bonus depreciation against your active income. All right, so hopefully I didn't lose anyone, but I'll give you like a quick example, right? I was in a corporate sales job, making good money and paying a lot of taxes, right? And we found out about this. We said, okay, let's buy a short-term rental. Let's materially participate in it. And then we can use that depreciation to offset our income, right? So it's just a good way for people that are not full-time real estate investors to take advantage of this to lower their effective tax rate with short-term rentals. So hopefully I didn't confuse anyone, but is there a simpler way to say that? Anyone that knows that?
What kind of money are you talking about? So like I'm familiar with cost seg studies,
Yeah.
but how does that?
Yeah, so quick math, right? You buy $1 million property, or I'll use an example, right? Because I just bought a property for $400,000 right here in Front Royal, right? So we're estimating that after the cost segregation study, the bonus depreciation on that property is going to be about 25%, right? So now $100,000 against my income this year is reduced, right? So if I'm taxed at 30%, it's a $30,000 tax savings for buying a cash flow producing appreciating asset. That's a pretty good deal.
What's the cap to that? I've heard a couple different answers. Like, say I make $600,000 a year.
That's a good question. I'm not aware of any cap, and there could be one, but I have a buddy that makes $700,000 a year. He's an executive at Wells Fargo, and he just bought an $800,000 property in North Carolina, and he got 30% of that. So what's 30% of 800,000? Like 340? Yeah, so he was able to take $340,000 off of his taxable income this year, which is pretty good for him because he was paying a lot of money, making $700,000 a year.
I have seen people that are making $2 million a year and paying very little in taxes because of this. So, and if you're a business owner, and you're depreciating your equipment as well, it's like I have yes, exactly. But I mean, I think I have not seen a cap.
I was asking for a client, and he's under the impression that it caps at $600,000, and that's what he was able to do.
There's nothing in the code written about a cap.
Yeah.
I think you need to talk to your CPA about it, but I've seen people or companies that are buying real estate, like commercial real estate in big, big chunks of, and there's no cap there. So, yeah, I think I will again talk to your CPA about it, but I haven't seen it. And
cool. Yeah, and there's a couple articles under the resources tab on my website, but if you just Google search short-term rental tax loophole, I mean, there's tons of articles, there's tons of videos. It's basically a way for people that are working other jobs to take advantage of the bonus depreciation with real estate. And again, I have not found a better way to do it. So if you have better strategies here to reduce taxable income, open a business, buy equipment like Gage, if there's other ways.
And there's also something to consider here, because we always refer to it as a loophole, But it is not. It is written in the tax code, and it's your right.
Yeah.
If you want, it is like, if you want to take advantage of it, it is your right to do it. So it's not, you're not doing anything wrong, you're not taking advantage of anything, you're just doing what you're supposed to be doing, which is, like building,
Stimulates economic
building
growth.
housing, you're building, and when the STR it's treated by the IRS as hospitality, it's not treated as real estate. So that's why it is kind of like a gray area between real estate and hospitality. But it is your right, you can do it anytime.
And at Gage's point, the code is written, right, so people stimulate, right, like the economy, right, and like buying real estate and doing hospitality is good, right? So it's written in a way that they want you to do certain things, right? So understanding what those things are and doing them is going to help you, align your income with the tax code.
And that's what the government wants. I mean, that's what, that's how it's built. We just don't know about it, or at least I didn't.
And CPAs, a lot of CPAs
don't know about it either. But it's there for you to use anytime.
What's awesome about that is the Shenandoah Valley is one of the biggest, best Airbnb markets in the country. And so we are like on a gold mine with that. So hearing about that here is actually super cool.
And also, Airbnb has changed. So what I've seen is that the properties in the Shenandoah Valley are still cash flowing. Not that doesn't happen everywhere in the country anymore. But the Shenandoah Valley is still a very good market for STRs.
Whole business platform. and this part of it. This is why people line up to have these cabins built.
And they're beautiful.
Would one of you mind explaining the way you can do passive tax loss through P1 and P2 situation, where P1 is a high earning W-2 income, and P2 is a real estate professional? How does that unlock the losses that can be converted against the W-2? That's
so if you have a spouse that is a real estate professional and you file jointly, you don't need to qualify for this, right? So if one spouse is a real estate professional and you buy property and you put it into service, you can take that against, like if your wife or spouse works a job and then you're a real estate professional and you file jointly, you can do it. So that's another good way to do it.
The concept is that you don't pay. So the way the IRS sees it is that you don't. So when you're not putting work into your asset, then it's considered passive. So you're not allowed to get any of these depreciation strategies or anything like that. But if you're actually working on it, is your job. Is not only investment. So it makes it active. So what happens is that if you have a W-2 job or wherever you're getting your income from, and your spouse and you're joining. You're filing jointly. What happens is that you're considering that. So for us that we have real estate professional status, it's our job. So we can actually depreciate things because that's our job. But for people who with a W-2 job or whatever that is not real estate professional, the spouse can be doing this and put in 100 hours a year. And as long as they're putting the most of the work, and there's other little rules, like the property needs to be rented for less than 7 days, at a time, or things like that. So when you're joining, I keep saying this, when you're filing jointly, you're considered one entity because it's one household. So because they're already putting that work, then it's considered active. So now you can get those losses from your overall income.
So what a lot of people do is they, buy a property in Shenandoah, right? They meet with a realtor, they meet with a lender, they meet with a contractor, they log the hours, right? They go there for a couple days, right? They furnish it and they log the hours, right? Because you need to do more than 100 and more than anyone else the year that you place it into service, right? and then they're able to take advantage of, the tax benefit. But I think it's really important. You have to buy right, and you have to still optimize the asset. I've seen people buy real estate for the depreciation, and then they buy a non-performing asset. That's a liability. Well, that's a bad buy. You still have to buy right. But if you start planning for it in December, it's going to be tough to do it, right? So that's why it's good to do it now. And there's a lot of great opportunities here in this market because home prices are still relatively low for what you can bring from an income perspective.
Okay, so about the short-term rental loophole, what if you're retired? You don't have a W-2, so you're retired.
Can you speak up a little bit?
What if you're retired
Okay.
for the short-term rental? You're retired,
Okay. So you don't have any active income.
right?
Okay.
And two, how many short-term rentals can you have to take advantage of the loophole?
You can buy as many as you want in
As
the
long as you can
calendar
do
year.
100 hours.
Yeah, and I don't think there's. I mean, if you don't have any other active income, I don't get the retired question that often, but I still think you can do it because you're basically you don't have that active income, right? Like the IRS is going to say, okay, like, do you have income elsewhere, right? Because then you can't qualify for real estate professional, status. But you should be able to do it, and you could buy multiple properties. And as long as you log more than 100 hours between you and your spouse, and more than anyone else on that property, it then goes from, passive to active, and that's where you can take it against your active income.
Can you carry the loss?
No, I'm asking, I don't have a W-2.
No, I know, but I mean, if you, let's say you do 2 or 3 properties greater than your income, can you carry the loss?
I'm sorry, what was the question?
So if you have this STR depreciation, and you have the, quote, depreciation on it, and it's greater than your income?
Oh, can you carry it into the next year?
Yeah.
I believe.
I don't think I don't know. I mean.
I think you can.
CPA.
Ask your CPA.
Yeah.
But yes, pretty sure you can.
And as a retired person, often your income will be drawn from 401k or from some type of pre-tax investment vehicle from a prior employer, and that is considered income. So your losses here can be written off against those. So that, as a retired person, is your tax advantage.
And we're not CPAs here. What Gage was saying, like as a real estate professional, you can carry that depreciation into the next year. But I think for the STR loophole, it has to be against active income that year, the year you're placing it into service and taking the bonus depreciation. But I'm not sure. It's a good question. I'll research it.
So I've got a W-2. My business partner is a W-2 as well. So if we were to go in on a short-term rental, we might be fighting over who's putting more time into it.
That's a big thing, yeah. Who's going to take the depreciation?
Yeah.
You guys could split it.
Can we-
You guys
can-
could
1 year each.
form an LLC and split it.
What I have seen is that, like, if you do it, if you're gonna, this is gonna be a business and you're gonna be buying STRs during the year, like, you do it either one STR each, or you do 1 year and then the following year the other person does it.
Right. Next question. So my wife's a stay-at-home mom, so she has no W-2. What is the minimum she would have to do in order to get real estate professional status?
750
hours a year.
Of helping me out on my properties, or?
If they're STRs,
Yeah.
it's only 100 hours.
Okay.
But if you're gonna do a long-term rental, you're gonna do like more real estate stuff, then it's 750.
Okay.
Yeah, I think that's big. And I went through the same situation with my wife, and we were both working, and we were like looking at it. It's like, why are we both working and paying all these taxes?
Right.
She wasn't a stay-at-home mom, and then she left her job, so she could be a real estate professional, right?
And it's great. I mean, it works great. It's because you're doing it as a team, so it works better.
Right.
Yep.
Cool. Thanks.
A lot of people do that. Like Yeah.
And by the way, I've been investing for real estate for like 15 years, and I didn't know about it until recently, like a few years ago. So it's not like you got to be in the right rooms and have the right conversations to, you know, understand what you can do.
Any more questions? It's 7:20-ish. I want to make sure we have a little bit of time for networking. Any other questions? Great questions, by the way. Thank you all for carrying the conversation with your good questions. Go ahead.
There's just one more thing that I want to add, because you asked about retirement, and this doesn't have, I mean, it's not about after retirement, it's before retirement, that you can use your money, your 401k, and put it into a self-directed IRA. And if you buy real estate with that money, it's gonna basically be, you know, be like under your retirement accounts, and it's gonna be tax-free. So it's a very good idea to use your 401k money to buy real estate.
You have another question?
We arbitrage. We arbitrage our apartment. So does the short-term rental loophole apply in any way?
So did you buy the place this year?
We've been living in this apartment for 3 years.
But you don't own it?
We do not own it.
Then it wouldn't apply.
No, it would not work. Okay, great.
One more question here in the front, and then we'll.
Thank you.
We got a couple housekeeping items, and then we'll network. One more question up here.
Not me this time.
Me again. So, I'm sorry, just to clarify that short-term rental loophole, is that only for the first year that you put it into service? It's not a yearly thing, then?
Correct.
No, I mean, you can do it. So if you have had a property at a short-term rental that has been performing for 3 years, you can still do it this, you know, right now, but it's gonna.
You can only do it once.
So but what's gonna happen is that it's gonna apply with the rules of that other year. The 2025 was the first year of 100%. So not the first year, there was actually 4 years before it was the same thing. And this 2026 is always also 100%. But 2024 was 60. So, and the year before was 80, and the year before was 100. So my point is that if you bought it in 2024, then it's not gonna qualify with 100%. It's gonna be 60.
Okay.
Oh no,
So
40.
you could
Sorry.
still do it, but the amount would be less.
Right.
Right? It
right.
wouldn't be the.
But you can still do it.
So whereas qualifying as a real estate professional can be done every single year on a property that you own, this is only a one-time thing. Okay.
But my point is that if you bought it a long time ago and you have done it, you can still do it. Just the rules are going to apply for that year.
Okay. Let me skip through here real quick. Well, first of all, thank you guys. That was amazing. So much good information there. I hope you guys all got a lot out of that. Just a couple housekeeping things. Obviously, wanted to say thanks to our sponsors real quick. I think a couple of them are in the room here. Housekeeping items. Next month for July, we're going to be switching it up a little bit. We're having a barbecue, which is going to be at Gage's, one of Gage's short-term rentals in town, Front Royal on Winchester Pike. If you guys are planning on coming, we'd love for all of you to be there. Please make sure to sign up, register for the event, because we're trying to get numbers on food and things like that. And also, we're going to have a raffle. We're going to be raffling off 2 nights at our river property in Front Royal. So we need you to, if you want to qualify for that, we're going to have some other raffle prizes. Register, show up, and you'll have a chance to win that along with some other stuff. There's not going to be like this type of thing. It's just going to be hang out, network. We're going to have some vendors. If you guys know or you're interested in sponsoring the event, we're still looking for a few sponsors to set up you can set up a table, have tables with some sponsors there. And I think that's kind of it. Anything else? Did I miss anything? All right, break for networking. Thank you all.
Thank you.
Have a great month. We'll see you next month. Thank you guys.